Live from Singapore, this is Inside with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump reiterating his tariff threat, this time adding lumber to the list that already includes cars, chips, and pharmaceuticals. He also says a new trade deal with China is possible. The Canadian Trade Minister joins Inside as Ottawa seeks stronger ties with Asia and Europe to face Trump's tariff attacks. Shares of Southeast Asian ride-hailing giant Grab plummet after its revenue forecast misses estimates. We'll ask the CFO about that and whether it's still weighing a takeover of rival Go2. Alibaba's $110 billion AI fuel rally faces the earnings test. Will China's struggling economy play spoil sport? We tap Bloomberg Intelligence for an answer. And India just saw its first billion-dollar IPO listing for 2025 with Carlyle Group's Hexaware. The head of Carlyle India joins us exclusively on what's next as India's equity market struggles. Well, we can now add lumber to the list of goods on President Trump's incoming tariff list. His latest trade war broadside came at an investment summit in Miami, backed by Saudi Arabia's sovereign wealth fund.
I'm going to be announcing tariffs on cars and semiconductors and chips and pharmaceuticals, drugs and pharmaceuticals, and lumber probably, and some other things over the next month. I have announced that we will soon begin imposing reciprocal tariffs on any country that engages in unfair and unequal trading practices.
Trump later told reporters aboard Air Force One he was thinking about a 25% rate for the lumber tariff. This will likely have the greatest impact on Canada, the biggest foreign supplier of the material to the U.S. Lumber prices have surged almost 10% since the end of January, as Trump threatened sweeping 25% tariffs on most Canadian goods as well as reciprocal levies. Joining us now is Mary Ng, Canadian Minister of Export Promotion, International Trade and Economic Development Minister. Good to have you with us.
Always
a new
good
day.
To be here. Always good to talk to you.
A new day, a new tariff, and this time it includes lumber. How are you looking at the expanding list of tariffs?
Well, when the executive order first came into Canada, very recently, it included 25% across the board on everything, including, everything, and then 10% on energy. What we're pleased about is to be able to work with the American administration to get a 30-day pause on that, and while at the same time working with the American administration. We've been very clear, tariffs are expensive for America. They make no sense. When 70% of what I export into the United States takes, adds value to it, and then helps them be more competitive with their products. Adding a tariff just simply makes it more expensive for Americans. Adding tariffs to Canadian exports simply means that it's going to cost Americans more at the grocery store. It's going to cost Americans more at the pumps. So it makes no sense. We will continue to reiterate that message. We've been very clear. We will not. We don't want to be here. We don't want to initiate anything. But should there be punishing tariffs on Canadian and on Canada, we will respond accordingly. But in the meantime, we are having conversations with the Americans, as we do. When you have a trading partner like the one between Canada and the United States, where Canada is our largest trading partner, but we're pretty important to the Americans as well. When I count 36 American states as my top customers, I sell more to them, to those 36 states, than China, than Japan, than the United Kingdom and France combined. So we need to work on this together.
That 30-day pause, you're in talks right now. How confident are you that can be extended, that will be extended?
We are working very hard on that, myself, the Prime Minister, my cabinet colleagues. This is a really intentional effort to work with the administration. One of the things that the American administration, including the President, have raised concerns about is how we can collaborate and do more on border to make sure that at the border we are indeed working more together. Despite Canada only having less than 1% of fentanyl going into America, it too is just as a concern for Canadians. So collaborating together to make sure that we are doing more on our border is what we are doing. And we're confident that that work is not only making progress, but that we're doing that with the Americans. And this is the testament of the Canadian-American relationship as well. The ability to talk through and work through what are sometimes really tough issues. So we're committed to doing that on our end.
You talked about how Canada exports more to the U.S. than any other country. We're talking about almost 80% of your exports going to the U.S. Despite a trade agreement with the likes of the EU, why has it been so difficult for Canada to diversify its trade?
Well, I always say as the trade minister, negotiating trade agreements are about, it's like building a bridge. But what you want is you need your businesses to walk across that bridge. And I think businesses really are reflecting on the importance of diversification. I think that the meaning of diversification has a greater significance. It's why I'm here in Singapore. I just led a trade mission to Australia. Over 200 Canadians that are here looking to pursue opportunities in this market. Here in the Indo-Pacific and in Singapore, who's a partner in the CPTPP, we have been doing business and have seen our trade increase by over 20% since it's coming in force into 2018. I've taken hundreds and hundreds of businesses on trade missions, whether it is here in Singapore or to Japan or to Korea or to Malaysia, to Indonesia. We just wrapped up a free trade agreement with Indonesia. But I think that what the Canadian government has been doing is really building out that deliberate infrastructure to help Canadian companies look at markets like these ones. This is a really important place for Canada. We launched our Indo-Pacific strategy at the end of 2022, backed by a $2.3 billion investment over 5 years to do exactly that. Grow our businesses, create those partnerships. Yesterday here in Singapore, I announced $7.3 billion to build a Canadian trade gateway for nuclear energy. This is really important because in the region, in all of these discussions I've had with partners, energy security is an issue. These economies are growing, and they want to be able to grow with reliable energy in order to grow their businesses, to power their cities and their communities. So we want to be a part of that solution. So these are the kinds of things that we're doing as a government, but we're doing it in partnership with businesses. And I would say, and I keep saying to businesses, you've got to show up, you've got to be here, do these transactions because they actually will be great for our trading partners as well as for us.
Minister, we keep getting headlines from Trump, and just today we heard from how he is willing to perhaps rethink that trade deal with China. He says it is a possibility for a new trade agreement with China. It does seem he is approaching China in a very conciliatory way. Instead of 60% tariffs, it's 10% tariffs, whereas when it comes to a trading partner like Canada, he was willing to go full force with 25%. Is there a sense, perhaps, that Trump is treating China in a better way than he is treating Canada?
Well, I can't speak for the president, for President Trump, but what I would say for Canada is that, Canada, has everything it needs to be successful in today's global economy and into the future. The United States is our largest trading partner. We will continue to work with the United States because it's good for Americans. I mean, millions and millions of jobs are dependent on America's trade with Canada. The inputs that we send to the United States actually create and have built these resilient supply chains that are good, that are good for businesses, that are good for communities. I think what we need to keep doing is to do this work. But Canada also has, through its current trade networks, access to 65% of the world's economy through trade agreements, like with the European Union. Here, through the CPTPP, with countries like Singapore and Malaysia and Australia and New Zealand and Vietnam and so forth. But also, I'm at the negotiating table with ASEAN as a bloc. I've just concluded an agreement with Indonesia, really excellent trade agreement there. Launched exploratory dialogues with Philippines. So I think the work we need to do and we need to keep doing is make sure that we continue to strengthen North America on the one hand, but also pursue these opportunities. And in Canada, I often say to people, we are the best traders because around the world because we come from around the world. So these deep people-to-people ties, I think, is also an advantage.
Is there a need for you to have a new trade strategy under the Trump administration? I mean, concessions don't work. We saw that with India, and tit for tat is not working either. Is there a way of relooking at your trade strategy?
Well, let's remember that the agreement we have today with the United States, which we renegotiated with the United States, was actually done by President Trump. And he touted this to be an excellent agreement. It took us time to do that, and there were issues that we had to work through. But we did work through them. We negotiated across the table, and in President Trump's trade memoranda that he issued to the Commerce Secretary and to the USTR was to take a look at the range of trade agreements that the United States has with the world, including in Canada, and including the work that the work that is done between Canada, U.S., and Mexico. I'm looking forward to to understanding what that analysis will come forward with. But ultimately, I think that at the end of the day, it's about finding the win and the synergies that make America strong, the synergies that make Canada strong, the synergies that make North America strong, and I think that's the approach we've taken. We're going to have to take that approach and then adapt as we need.
Might the win come from a multilateral response instead of Canada just responding on its own? Should there be, a global response led by perhaps Canada, Asia, or even Europe? Should there be a multilateral approach to responding to Trump's tariffs?
Well, I've certainly, been talking to my colleagues around the globe, particularly those who we have trade agreements with, and those partners who really stand up for the rules-based trading system. I was in Europe just a little over, I'm losing track of time, I think it's a little over a week or maybe 2 weeks ago. I was at the World Trade Organization. I'm here, of course, in Singapore, our CPTPP partner. I was just in Australia, and I'm on my way to Brunei. And I think the one thing that is consistent with all of us, because in response to our businesses and the investors, they are looking for governments and for those of us who have negotiated these agreements to provide the predictability that they need. So everyone agrees that standing up for a rules-based international order, particularly around trade, is something that we are going to need to work on together. Each country will do what they will do with respect to unique responses, but I do think that there is agreement that the rules-based international order, particularly around rules-based trade, is something that we must stand up for and continue to work very hard at defending.
With Trump reshaping the global trade book, I'm just wondering, from Canada's perspective, is China now a more important trading partner? Is India now a more important trading partner?
Well, our Indo-Pacific strategy had, set out, and this is now well over, at the end of 2022, we set out a strategy that envisages the importance of this region in particular, that also includes how Canada would work with China. And there, we refer to it in the strategy as the 4 Cs. There will be opportunities where we should absolutely be collaborating together. You think about climate change and how we can build out solutions, including economic solutions that actually will fight climate change. There will be issues where we're going to have to challenge China, because the values that are important to Canadians are such that we need to do that. We can also compete. I mean, take a look at AI. Take a look at what Canada is doing in the critical mineral space. Take a look at what Canada is doing around the battery ecosystem with respect to batteries around for electric vehicles, and how we're attracting investments from around the globe to do this in Canada. So we can certainly compete, and then we need to coexist. So the approach that we have taken in the Indo-Pacific strategy, I think, still holds today.
All right, Minister, thank you so much for joining us. Perfect day to have you on the show. Mary Ann, Canadian Minister of Export Promotion, International Trade and Economic Development. Stay tuned for an interview later Thursday. U.S. Treasury Secretary Scott Bessent will be joining Bloomberg Surveillance. That's happening at 8 p.m. in Hong Kong. And if you're in New York City, it is 7 a.m. We've been talking about China on the back of Trump saying that, he may just consider a new trade deal with China, taking a look where the benchmarks are right now under pressure. As we speak, CSI 300 index down 0.4%. Hang Seng also in negative territory, currently down by 1.6%. Trump saying that a new trade deal with China is possible. And still ahead on Inside, Grab's U.S. listed shares fall as its full-year revenue forecast disappoints. CFO Peter Oey will be joining us to discuss the numbers as well as talk to us about the takeover of its rival GoTo Group. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Grab shares plunged in extended trading in New York after the company forecast full-year revenue that trailed estimates. Its outlook suggests caution around the Southeast Asian ride-hailing and food delivery market, where GoTo Group remains a formidable rival. Early in the week, however, Grab shares rose sharply, with the company seen benefiting from changes to Singapore's tax policy. Let's get insights now from Peter Oey, Chief Financial Officer of Grab. Peter, good to have you with us. That slump in stocks, what are the key risks you're seeing that investors see in Grab right now?
We had a very strong Q4 and fiscal year 2024 result, Haslinda. Actually, was our strongest quarter ever and really sets us up nicely for 2025. And a few things here. If you look at our GMV, it was record growth for us. We have more users on our platform ever before. And we also have new milestones when it comes to profitability and free cash flow. So we're in a really good place going into 2025. And this growth momentum that we're seeing, we feel very strongly that it's going to continue in the business today.
But the thing is, when you take a look at the numbers, take a look at the data, growth has actually cooled dramatically. It was 3 digits before, not anymore. How are you intending to reverse that situation?
If you look at our growth in our business, actually it's been accelerating. If you look at our deliveries, for an example, we've grown, it was Q2 as we grew 14% on a GMV on a year-over-year. Q3 was 16%. We're at 18% we just posted on a GMV growth on a year-over-year basis. Our mobility business continues to grow. GMV also at a nice clip of mid-20s. So this actually has been, for us, very critical in getting more users on our platform and interacting on our platform today. The number of transactions on our platform today grew by 22% on a year-over-year basis. So we've got a really nice tailwind going into 2025, and this growth momentum that we're seeing, we expect to continue this year.
Well, the thing is, the elephant in the room really is that possible merger, takeover of your rival GoTo. Where are you with that? I mean, in terms of the latest negotiations and talks, where are you with that?
We don't comment on a lot of media speculation or rumors. When it comes to M&A, we have a very high bar. We have a very high hurdle rate. Organic growth is very critical for us. Now, when it comes to inorganic growth, we're very, very targeted. We're also very careful, very cautious in terms of those activities. While the hurdle bar is so high, there's just a lot of things that needs to happen for it to get across the line. So for Indonesia, it's a very important market for us. It's a key growth market for us. It's a profitable market for us. And if you look at the growth just from a quarter-on-quarter perspective, we grew at 10% on our GMV, which is growing faster than our group on-demand GMV business. And we're continuing to double down. We could double down in 2024 in Indonesia, and we continue to do so in 2025. So we're going to keep on just focusing on organic growth in Indonesia, given the potential it has for Grab.
But the thing is, Peter, if this merger were to happen, people say that it will create a behemoth, a monopoly even, and you have to wonder how the regulators are looking at it. Are you in talks with the regulators? What are they saying about it, and what's really the possibility of that happening?
We look at Indonesia as a whole as a critical market, and we need to continue to improve the product experience, which is really critical for us, and continue also to serve our drivers and our merchants. There is a very important ecosystem, whether it's Indonesia or also outside of Indonesia. So again, when we look at Indonesia today, we are only scratching the first surface. And we're going to continue to make sure that actually we outserve those customers and also working with the drivers and the merchants. At the same time, also working with the government. The government is a critical component of our ecosystem there in Indonesia. We work hand in hand with the Indonesian government. We're co-building at the same time as part of their continued expansion of their economy.
Well, it's not just Indonesia, it's also elsewhere that you're seeing great competition in the ride-hailing space. We talk about Bolt from Europe, we talk about Lala Move, we have Ride coming into the space at all. How are you assessing the competition that you're seeing?
We're not very, when it comes to competition in Southeast Asia, it's always been intense. It's nothing new to us. We've been around for over 13 years and always been a competitive landscape that we operate in. We've seen players coming in, we've seen players going out also at the same time. What's been really encouraging for us is our category position, whether it's ride handling or actually in deliveries, continues to be on the leadership when it comes to Southeast Asia. A lot of that actually is continuing to making sure that the investments that we're making on our product continues to enhance, attracting new users on our platform today. And that sets us apart from the competitors and our peers today. And that market share that we're continuing to grow also is an indicator of that customer experience and the customer love that we're seeing across all the cities that we operate in today.
But isn't it true that the competition is impacting your profitability? We've already seen how Grab increased its incentives, in fact, 30% more incentives in Q4. How might that play out later on, and how do you see the need to continuously provide incentives to the users?
Incentives for us is a lever that we use, less about competition. It's more actually making sure that the marketplace is healthy. If you look at a lot of the incentives that we've deployed in the previous quarters, is really around product adoption. Well, we have a lot of new products that we introduced last year in 2024, in the first half and the second half. We use incentives as a lever to go to market, and we've seen really good traction on those adoption and order frequency also at the same time, whether it's ride hailing or on the delivery side. If you look at the margins for our business from quarter to quarter goes up and down, and that's intentional, and it's in line with our expectation. And if you look at where our focus is to make sure that actually we don't compete on price or compete on fares, it's really more about product differentiation that actually sets us apart from our peers. And that's a really critical focus for us. And we use incentives as part of that lever in growing the business and also expanding margins.
You talk about new products. That includes digital finance. How's the ramp up going in Indonesia as well as Malaysia?
And Singapore also. We have 3 digital banks, Singapore, Malaysia, and Indonesia. We're very excited. There's a ton of work that has been gone behind the scenes. We have now close to 4 million customers across those 3 countries in our digital banks. We've got close to $1.2 billion of deposits already as of the end of fiscal year. And the banks are really excited in launching the lending products now across the board. We've introduced some of that on the tail end of the second half last year. It's a big year for our digital banks, and it's a really very ecosystem-driven play when it comes to our product set with our digital banks. Over half of those users on the digital bank platform today are from Grab. And we see a lot of benefits that we're seeing in making sure that the on-demand pieces and the digital banks are actually cohesive, working together, because it really drives that retention and also just the LTV of our user base.
Peter, thank you so much for joining us. Peter Oey, Chief Financial Officer of Grab, of course, out with earnings just overnight. Still to come, Alibaba faces an earnings stress test after adding over $110 billion to its market value in an AI-driven rally. We'll look at what to expect in Thursday's report next. That's coming up on Bloomberg. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Even as President Trump says a trade deal with China is possible, its stock rally is taking a breather today. Meanwhile, longtime bears Morgan Stanley have made a major pivot, upgrading their target for the MSCI China. Avril Hong is here with more. And what's behind this shift?
Oh, Has, the bears have caved. I mean, Morgan Stanley didn't even budge after the October rally, but they finally have. And as to the why, it's this technological breakthrough that they're citing, as well as a regulatory shift. So they've upped their view of the MSCI China. They see it at 77 before the year is up. They've upped the view from underweight to equal weight. Flip the board because they're pretty much joining this chorus of bullish views on Chinese stocks of late from Goldman Sachs, UBS, JP Morgan as well. Now, it's worth noting that even though JP Morgan is constructive on AI long term, they are kind of flagging that maybe it's wise to trim the exposure to some of these China AI proxies. You look at the RSI on a number of these MSCI China constituents, well into overbought territory, above 80 on some of them. You flip the board again. I just wanted to show you, of course, the hot stock this year, Alibaba. And just to give you a sense of how hot it is, it's ticking a number of boxes, right? 50% up for the year and well in overbought levels. Also, look at the fear greed index. Bulls are in control. It's also above the 12-month PT. Of course, these earnings are going to be a key test for the company, but also the Hang Seng, given its weightings. And keep in mind that we have options traders expecting a bigger than usual move in the stock after results.
50% year to date, and we're only in February. Of course, that AI play is really intact. Avril, thank you so much for that. Let's take a closer look at what to expect from Alibaba's earnings and bring in Bloomberg Intelligence senior analysts Catherine Lim and Robert Lee, both in Hong Kong. Kat, let's start with you. What are you watching for in their e-commerce business?
Right, Haslinda, the hot stock needs to keep the heat up. And I'm really looking forward to, where that is going to come from this evening. I'm just going to touch on e-commerce and let, Rob give you his take on cloud. But e-commerce front, let's watch for China. Let's not forget that, China with the stimulus that's going on, I do believe that market is watching for that sentiment uptick and whether the consumers are now being stimulated to actually spend more. So that's domestic, and then going into overseas, AliExpress, as some of their overseas platforms sells more overseas, are they being hit by the tariffs? And what are the steps that's taken to ensure that this money-losing unit, and again, I stress that, it is a loss-making business for Alibaba right now, whether we should be expecting more losses or hit, or maybe things will turn for a better as we step into 2025.
The thing is, Kat, if you take a look at the quarters ahead, the macroeconomic headwinds are still there. We talk about consumption and stimulus, but consumption numbers are not looking that promising.
Right, yeah. We have yet to actually see the China retail numbers coming through. Look, January, we know that there was the Lunar New Year effect. So things going to be on a more upbeat level. Now, this month is the crucial month, and the data will be out next month. So we're going to have to actually see whether Alibaba gives us a sneak preview to whether sentiment has actually held up over the last, 20 days of February.
Well, Rob, let's take you into this conversation. Cloud AI, they say that is the future for Baba's growth. What are you expecting, and where do they go from here?
Okay, thanks, Haslinda. As you know, we published the China AI deep dive in November last year. And one of the subheadings on that was China AI progress, not profit. So I think DeepSeek's recent technological breakthroughs have demonstrated, the strong momentum on a technological front, on a development front that China's making, closely positioning the country behind the US. However, it's a very commoditized sector. The route to monetization remains very unclear, and that has a big read across for all companies, including Alibaba. So I think whilst Alibaba is well placed to benefit from an increase in development activity as a result of DeepSeek's breakthrough, that should benefit their cloud business. The cloud sector in China is, incredibly competitive. There's huge margin pressure at the moment. I think Catherine's flagged in her research as well. There is a risk that margins on Alibaba Cloud actually become maybe below expectations for this quarter. But I think that the key point that we've been making, both in this deep dive report and more recently, is that, again, China will continue to progress well on the technological front, but the route to monetization remains very unclear, and it's not going to have a transformative effect on any of the companies. And therefore, I think, what we're seeing in the markets in the moment is more driven by hopes and maybe hype than the reality. The earnings outlook for most companies in the China tech sector remains unchanged by DeepSeek.
That's right, Rob. And to that point, we know that some are saying 2025 is a pivotal moment for AI on the back of DeepSeek. I mean, you got to wonder how this might just play out. If there is a shakeout in the industry, how might this play out for Baba?
I think ultimately something like that is required. So we need a consolidation which will put the remaining players, of which I think Alibaba, Tencent, Huawei are definitely well placed to be the long-term winners. That will put them on a much better profit footing. But it's a very fragmented industry in the cloud sector. And most of the companies, I could probably reel off at least up to 10 names. They're all very large, cash-generative, well-capitalized companies. That includes the 3 telcos, the aforementioned companies. So I guess if you're going to see a consolidation, the weaker hands need to drop out, don't they? Essentially, they would lose money, they'd fall by the wayside. Because it's such a fragmented industry in China cloud and populated by these very large tech platforms, it's hard to see who the marginal players are. And therefore, I think that means we're going to continue in the current vein, very high level of competitive pressure, very high level of pricing pressure, which makes it hard for anybody to break into sustained profit. So again, it doesn't mean Alibaba won't benefit from increasing development activities on the cloud business. There's probably some revenue upside on that front, and tying in with the recent development on the Apple front, which is probably more interesting for them. But it's going to be very hard for them to convert that to profit.
Rob, thanks so much for that. Bloomberg Intelligence senior analysts Catherine Lim as well as Rob Lee. And of course, you can also turn to your Bloomberg for more on Alibaba's earnings. Go to TLive Go to get commentary analysis from Bloomberg's expert editors. Now, the Deputy Governor of Australia's central bank says policymakers are still rigorously focused on inflation, although no single piece of data can trigger a rate move. Andrew Hauser spoke to us after this week's rate cut and the first in 4 years for more on the RBA's thinking about price pressures.
There's been a great deal of positive news about inflation in Australia. Just to remind you, and you know this, we adopted a somewhat different strategy to tackling the inflation spike in Australia to other countries. We raised interest rates to a level we thought that were restrictive, but we didn't raise them to the sorts of levels that other central banks had done, precisely because we wanted to protect the gains in the labour market. And as I think you've been talking about earlier, labour data out today show that the labour market in Australia has been incredibly strong, but inflation has also come down as well. What we said in December is that we would form a view about whether we become sufficiently confident that inflation would come sustainably back to target, to the midpoint of the target, 2.5, to begin easing. We did reach that position of sufficient confidence, but this is not a done deal yet. The underlying rate of inflation is still 3.2%, which is slightly above the band. The headline rate of inflation is in the band. And so although we've removed some of the restrictiveness that we had in policy, there is still restrictiveness in the system, and we still need to see a bit more good news on inflation coming back to that midpoint.
And the jobs data was quite nuanced, right? Because even though unemployment ticked up, even though we saw more jobs than expected full-time being added, participation is still really high. The wages data this week showed, further slowing. Does that tell you that some of that robustness might start to fade in the coming months?
Which bit of it shows you that it might fade?
That we're starting to see the signs of perhaps a little bit more vulnerability in the labour market. And of course, Australia's not the only one that's kind of dealing with that scenario.
It's quite hard to see bad news in the latest employment data. They remain very strong. strong. I think the debate about the labour market is a slightly different one, which is, although we know employment has been growing strongly, inflation has been coming down. And as you say, wage inflation has been coming down too. And so there's a very lively debate about whether that employment growth leaves us with less capacity in the labour market or a bit more. If there is a bit more, then inflation will come down more quickly than we're predicting, and that'll be good news because it would mean that we can adjust policy more rapidly. But we need to see more information on that, I think, before we can be sure.
What do you see as the biggest risks facing the economy?
Anyone who tells you they know how this is all going to shake down in the long run is wrong, right? We're all learning. Things are moving very quickly. I think one of the important points I'd say is actually that very uncertainty about trade policy and about outcomes in general, globally, not exclusively in Australia, may itself have an effect on activity in Australia. So if you're a firm or if you're a household planning to make an expenditure that in some way depends on a certain outcome in the global economy, and you know that who knows what's going to happen in the next period, you might just wait. Now, waiting is very sensible for an individual, but it could be really bad news for the economy. So I think for me personally, one of the factors in the decision this week was actually a sense that, look, maybe that pervasive uncertainty itself may have some short-term depressing effect on activity.
And that was RBA Deputy Governor Andrew Hauser speaking to the Asia Trade co-anchor Heidi Stroud-Ward. Still to come, we'll be joined by Amit Jain, India head for investment firm Carlyle, for his insights on the country's IPO market and the tariff threat. Our exclusive conversation coming right up. Keep it here with us. This is Bloomberg. Here's a look at Indian markets just ahead of the open, happening in just under a minute. Currently, futures pointing to a lower open. The Sensex down 0.4%. The Nifty also lower. Of course, the Nifty capping 13 consecutive sessions of declines on Wednesday. Its worst losing streak on record. Those consumer stocks having its worst losing run after the tax cut rally wears off. In terms of the Nifty futures, currently down 0.3%. Now, as we await that countdown, one stock to watch today is Carlyle Group's Hexaware Technologies. It jumped almost 8% on Wednesday after India's first $1 billion IPO of the year. The listing values the software and tech provider at more than $5 billion and shows some improving investor sentiment after recent large offerings struggled amid a broader Indian market sell-off. Well, joining us exclusively as we await the open is Amit Jain, Managing Director and Head of India at Carlyle. Well, against the odds, we saw that jump for Hexaware. I mean, 8% upside at the close yesterday. Some say perhaps that could be a risk of overvaluation now. Amit, how are you looking at that?
Well, I think firstly, let's step back. I think it's such a momentous occasion for Hexaware, Carlyle, and I would say for the thriving markets of India. You know, this is, as you just said, $1 billion IPO. And if you double click that, it's the single largest tech services IPO in this country ever. I'm being told this is the 10th in the last 10 years. This is the single largest tech services IPO globally. It's the largest relisting ever in India, right? And this is the 7th IPO we have done, which makes it, again, the biggest IPO backed by a single sponsor in the country. The reason I'm highlighting this many first as milestones for this IPO is, I think, to the underlying point, which is, number one, the quality of the asset, but equally importantly, the depth of the capital markets in India at this point in time. So I see your screens, sometimes green, sometimes red, but I think you have to take a step back and see the depth of the markets, which India has now created, driven by domestic liquidity. We spoke about it the last time I was on your show, SIPs. I think it's incredible, and I think it's a testimony of the quality of the asset and the depth of the market.
But there's so much uncertainty in the world today, Amit. This is a company that's reliant on the US, on Europe for its revenues. There's still a lack of clarity in terms of those Trump tariffs and how that may weigh on companies as well as growth. How are you factoring that in?
Yeah, actually tough and uncertain markets. I'll go back. I was talking to somebody yesterday at the ceremony. When we were young children in the school, some of the smarter kids in the room would go to the teacher and say, give me the most complex, tough paper. Because in an easy paper, it is tough to differentiate among students. So I think in a complex, tough market, sometimes the good assets get the best reception because there's scale, there's quality, there's governance. And I think Hexaware has been a long-term compounder. This used to be a public company, went private. And if you look at the numbers of this company, has consistently grown out of the industry and have delivered strong value to its customer and now to its shareholder. I think uncertainty is 100% there. And therefore, if you look at the distinction of what a large-scale company would receive today with quality versus maybe a mid-cap stock with a certain degree of volatility in the performance, I think that's where the differentiation is starting to come in. So the other way to think about it is, while at a large, you may argue FIs have sold out in India, we have seen such high quality and in quantity subscription for Hexaware in our IPO.
Uncertainty, hence volatility. The question really is whether, the market for the IPOs in India can hold up amid that volatility.
I mean, it is holding up. As I said, this is I don't want to repeat, but it is many firsts which just happened yesterday, and the stock was up as it closed. So clearly tells you, and it's in green as I speak. So, I think the public markets continue to look for high quality. Yes, there's distinction being made on quality versus lack of it, and increasingly that's good for the markets and its long-term sustenance. India's probably seen close to 100 IPOs last year.
Will the environment, will the macro environment, will the investment environment impact the kind of valuations potential IPOs will go through this year?
Oh, yeah. I think uncertainty does get discounted. That you're absolutely right, Haslinda. Uncertain environments do factor in higher, discounting rates, and that reflects in the valuations. Particularly, again, you have to discount that with, or put that in perspective with the quality of the asset you're putting in the market, right? So if you look at the mid-cap and the small-cap corrections in India versus the large-cap correction, amidst all the near-term volatility we have seen, the difference will show. So you're right.
Of course. Yeah, the conversations that we've been having have revolved around Trump's tariffs. I'm just wondering, how might that impact the appetite of foreign investors in India?
Well, look, again, you have to take a step back, as I said. In the last 10 years, since this government has come in and what they've been doing, it's a very consistent, predictable regime we are in. Consistent investments at scale in infrastructure, which is making more than one sector competitive, particularly manufacturing, push on domestic consumption. You've seen the recent budget where there's almost $13 billion being given back to the Indian consumer to spend, which will have multiplier effect on the economy. So as I said last time, India has its own story to tell and a promise to keep. So that's one part of it. And I think a lot of the foreign investment which is coming into the country is to play on this, rising middle class, 1 billion for people who are consuming more and spending more, and that thematic. Now, on the export side, I've always believed that business have to fundamentally stand on its own merit. Their competitive mode cannot come out of a tax holiday or cannot get a survival threat on tax tariffs. Businesses have to deliver on innovation. They have to deliver on their cost competitiveness. They have to deliver on their agility. And most importantly, their stickiness and the relevance to their customers and the economy they're serving into. Because when that happens, I think the stakeholders in the ecosystem come together to find a solution. And some of these uncertainties or complexity could come not just from tariff. Right after COVID, we have seen shipping rates escalate in a disproportionate manner. And the same question came, could countries export to their destinations? Because the shipping rates and the freight was almost making it look global kind of travel of commodities or goods unviable. But didn't happen. Things solved for themselves. I think, so when we look at companies and look at the micro, look at segments, do you have global competitive advantage? I think companies and countries have to ask this question themselves very, very honestly and scrutinize for the moat. Where is that moat coming from? Is it structural or is it based on some tax holiday or geopolitics?
Amit, India may not be losing its shine yet, but it can be more attractive. We spoke to Carson Block. He says one issue really is with capital gains tax. Take a listen to what he had to say.
lot of our clients are non-taxable in their home domiciles. So for them to get clipped 15 or 33% is a pretty big deal. So my understanding, and I don't know that much about India yet, but my understanding is that there's really no discussion of changing that regime. But I would say that if India is serious about getting foreign flows into its capital markets, they need to exempt foreign investors from capital gains tax.
So, Amit, how is Carlyle looking at capital gains tax in India?
Well, I think, again, if you look at the long term of this country, the capital gains tax, the government is all for capital formation. I think they have a stated agenda. If you step back as a domestic income generator, if I were to put my money in fixed deposit, the interest is taxed depending upon your income slab. At the highest slab, it is taxed 43%. If I were to put money in capital markets, in 1 year, I'm taxed roughly about 13%. So you can see what the government is incentivizing from a tax standpoint. They really want risk capital from domestic money to come in and participate in enterprise formation of the country. And I think it's the same thing with foreign investor, right? There were times when there were tax holidays when initially private equity started, and I think still the tax rates are pretty attractive, and it's predictable. You can price in. The good news of this government in the last 10 years there's been no, I would say, retrospective surprises, and there have been high degree of predictability. And I spoke about it. Predictability drives consistency, keeps anxieties low, keeps discount rates in a predictable manner. You can price walking in what you have to pay walking out.
We have to look at markets in relation to the others. I mean, there's a lot of talk about how the U.S. is the key game in town because of the domestic policies favoring the U.S. markets. How might this play out for India? Would India become less attractive? And when it comes to Carlyle, how is India's, in terms of investments in India, how does that compare to the rest of the world?
So, look, there's enough for two economies and two large economies driven with their own kind of investment thesis to deliver. So I personally see this as a trade-off between India versus US or India versus XYZ. As I said, I think India's story, the good news is there's a lot of the domestic consumption, 65 to 70% of our story is purely domestic. One has to come to India to participate in this story, which has been very secular. For the last 20 years, this country, except the year of COVID, has delivered a very narrow range of 5 to 7% real GDP and a very range-bound inflation of 4 to 5%. So the nominal growth of 11%.
Right.
We remain the third, fifth largest economy, the fastest growing large economy in the world, now fourth largest capital market. So one has to come to participate. Should one choose to participate? Yeah.
In 30 seconds, apart from consumption, apart from financial services, which other sectors are looking attractive? In 20 seconds.
Well, I would say services, export-oriented services. And we do think India has the opportunity now to create manufacturing hubs, both for domestic markets and on that scale, create export-oriented hubs. So our last deal is in auto component segment, where we have put together two companies and we want to scale that platform, serving both the domestic and the global markets.
Right. Amit, a pleasure speaking with you. Amit Jain, Managing Director and Head of India at Carlyle. Stay tuned for an interview later Thursday. U.S. Treasury Secretary Scott Bessent will be joining Bloomberg Surveillance at these times on your screen. And tomorrow on Inside, CraneShares CIO will be joining us. Keep it here with us. This is Bloomberg.